Hey, good morning, everyone. This is Kirk here again at Option Alpha, the members only video update for January 31st. Geez, January has gone really fast. I don't know about you guys, but at least it did for me. Sending out another alert today. Pretty quiet on the naked puts and calls front, but hopefully we can increase that a little bit more with some more relevant alerts. As always, I'll make this blanket statement is that I'm not going to force trades into the market just for the sake of having them fill a portfolio. I know I get a lot of questions from people about trades. And look, if you want to make trades every week, every day, every hour, be my guest. But I've been doing this for a while. It's worked for me. And that's how I'm going to continue to run this newsletter by not forcing trades. I'm going to make trades when I think that it's a good time to make trades. I'd rather stay in cash sometimes and let the market work its way out until I see something that is a little bit more favorable than where we are. So that's my opinion on just staying in trades. I don't think it's a bad thing. I've always preached on the blog and on this site that if you don't know what's going on and if the market has no real clear direction and risk is kind of more on your side picking a trade, then just stay out of the market. Leave your positions in cash and wait to fight another day. But again, hopefully we can increase that a little bit more here as we get into March, which has about 45 days left to go in expiration. So a very good kind of middle of the road point between our target of 30 and 60 for entering new trades. So we can definitely start to add here. I wanted to point out a couple things on this video real quick, hopefully make it short. The VIX, again, I use these acceleration bands all the time, and I've done a couple videos on this, but again, the VIX had a breakout lower in the acceleration bands, judged by these blue ovals, and then again, came right back inside. Now, the problem that we're dealing with right now in the VIX is that even though it breaks out lower and does pop up, we do have a couple days that it just kind of pops up and volatility jumps up a little bit. We've been trending downward the whole time. So what we really need to see is we really need to see us break that middle line, really that kind of almost signal type line with the acceleration bands. Break above that line first before we can start to really possibly hammer out a bottom here short term in the VIX. But definitely volatility is going to play a big impact on premiums and spreads and strategies you're going to use. With low volatility, you just have to move out a little bit further. We don't have the ability to sell options, 20 and 15 days from the market with the VIX back up at 50 like it was in August. That's just not an option that we have. If I go to the chart or to a couple things I wanted to show you guys, this is actually the most recent spreads for all the major problem children, really, in Europe and as it compares to Germany. I think the one that was noted that's really important is Portugal here. Look at the spread between Portugal and Germany's 10-year bonds, and it's just really gone through the roof. Now, all the other ones really haven't adjusted to this yet, but you can see that they're all continuing to trend higher. We've had a little bit of a dip since the end of the year in most of the spreads, but more or less, if this is a stock chart, again, long-term trend looks higher to me, especially Greece, Portugal, Italy is not looking that good, continuing to start rise back up. So again, just keep this in the back of your mind. I think most of the investors are kind of dull and numb to this stuff now, but it's important. I think it's something that we need to keep fresh in our minds. We need to keep looking at it all the time. Here's an example, I guess, of why I think it's just I don't know why it's crazy, but I guess just proves the point that investors are bombarded with so much information in the news on any given day that it's hard to decipher what's going on. So I think now we've reached the point to where this Europe stuff it's just constantly there, good, bad, or indifferent. And so people are kind of numb to it, which is why I don't think that we're going to have a real dramatic sell off in the markets. I think we'll just be range bound, and possibly trend higher as we've done for the last month. But here's one headline. This is from Yahoo Finance out of Reuters, and you can see Eurozone jobless hits highest level since birth of the euro. That's obviously not good news, but stock futures rise on EU pact. So we have two huge news reports today. One, jobs horrible. I'm a jobs kind of thinker, in that if we don't have jobs, eventually the wheels are going to fall off the truck here. But this pact that the EU made to cut spending and keep the deficit in line, I think is a joke. I think they've tried to make pacts before, but they continue to ramp up. And even if they start cutting deficits and keeping budgets in line, that's only going to mean less jobs, less income for people, et cetera, et cetera. So that's my position on where things are going with that. If we get back to the charts, taking a look at the SPY, which is the trade we're going to enter today, what I like about it, let me get these Bollinger Bands off here real quick. What I like about this particular trade is that we have a lot of levels to get through should the market start to fall, right? And here's where the market did fall back in August, right? Pretty dramatic. So we're at almost the same distance as where, if that happened, we would be relatively safe. We obviously adjust before that point. But you can see that our strikes are pretty much near where the market bottomed. So even if we did have a huge fall in the market from right now, we'd be able to at least adjust or close out the position early. And if we didn't, we'd still be relatively far from the market. I think that the market is going to continue to trend higher. I definitely see a retracement at least down to 125 at some point here in February. I think it's almost a given that the market has to retest this level. This is a major level that it broke above as it was starting to break out here in the better part of December. So it's got to come back down and retest and confirm this level of support before it just kind of floats higher. If not, it's just going to do this kind of floaty dance. That's what I call it. Just a little floaty melt or grind higher over the next month, and real no movement is going to happen. So if it comes down and it tests that level, confirms as support, then you could see a much higher leap in the market after that. I think that we're definitely coming into some areas of resistance. That's been obvious for the last 30 days, really, and it's just more melting and grinding higher. But this recent top here from April of 2011, that's going to be major resistance as we continue to move higher this week and into the next. So again, watch out for these two levels. That's kind of where I see the market being range bound in this range, at least for now. We'll obviously adjust and correct our positions if the market starts to really turn on us. I'm going to be watching that closely, obviously. But I think that March and getting a good distance away from the market right now has been good. We played it pretty good in January. February, there's really not that much because it's a short month, so contracts were pretty limited, volume was pretty limited, not worth the risk in moving up the strikes up to 115, 120 to get fills. So that's why I didn't go with the February contract this month. As always, I hope you guys enjoy these videos. Please add comments right below to the trading alert so we can go through that. We had a pretty good discussion on the last one, so hopefully we can see some more comments on this one. Happy trading.